Thanks for coming back, Daniel. Let's talk about Deutsche Bank. Its shares rebounded today and the cost of default insurance is falling. My question to you is, are we starting to get out of the woods with this banking turmoil?
Hopefully. However, we cannot trust a bounce, especially because it's a low volume bounce, and we need to see whether it's a trend. I think that the messages of the European Central Bank about providing ample liquidity and at the same time the messages of Deutsche Bank itself, because they have done something which I think is the right thing to do, which is to start to purchase back some of the debt instruments that have generated part of this turmoil, the convertible contingent bonds. No, so that obviously generates some level of confidence, because if the bank is purchasing back those bonds that are perceived as high risk or that could generate an equity slump, obviously that improves. So there are small snippets of information that give a little bit more confidence, but we also have to remember that it's not the first bounce in banks in Europe that fades afterwards if the situation continues to be rocky.
Yeah, I want to go a little deeper in the European side, but first, let me get your thoughts on First Citizens Bank purchasing Silicon Valley Bank. What are your thoughts on that?
Well, that is a very, very important factor, no? Because when investors see that actually there is demand in the market for the assets of a bank, people start to see that, for example, that all of the assets of the other banks may have an interesting value, no? And now, particularly that valuations have come down, then people may have a mark-to-market of what is happening in the outside world. It's very different from other occasions, because remember that in other banking crises, one of the problems that investors found was that it was virtually impossible to have a clear picture of the value of the assets of a bank, because nobody appeared and purchased those assets at a reasonable price. And I think that the valuation attached to the Silicon Valley Bank assets is encouraging, at least as a way of understanding the valuation attached to the regional banks in the United States.
You know, we're talking about the banking troubles here, and the key word is confidence. You mentioned that a little bit earlier as well. What's your confidence level, whether on the U.S. side or the European side?
Well, it's very weak, to be fairly honest. The confidence requires that, on the one hand, banks are very cyclical businesses. Obviously, no, they lend to the real economy, they invest in the real economy, and they're very leveraged. So when you see a macro environment that is obviously weakening, and at the same time an earnings environment that is basically at least predicting significant downgrades in the S&P 500 estimates, etc., then confidence certainly comes down. If you add to that it seems that central banks are caught between a rock and a hard place. On the one hand, they need to combat inflation, raising rates and reducing the quantity of money in the system. And on the other hand, they're saying that they're going to give ample liquidity to banks. So, for example, the balance sheet of the Federal Reserve has unwound 67% of the quantitative tightening. So, you know, it's a challenging environment, and certainly, banks, being cyclical businesses, are the ones that probably suffer that turmoil the most.
You mentioned between a rock and a hard place, but I think a couple of weeks ago, the ECB hiked rates by 50 basis points. That's 25 basis points higher than the Federal Reserve. Does that indicate a message saying sort of banks are stable and inflation is the problem here?
I think that certainly the ECB did the right thing, which was to give exactly that message. If the ECB had gone out and been dovish in the interest rate hike, and at the same time say that banks are solid, immediately investors would have thought, well, banks are not solid. You need to U-turn on your policy. No? So I think that at least in that perspective, what the European Central Bank, what the Federal Reserve is doing, what the Bank of England is doing is consistent with the message. It's consistent with the message of banks are solid. We need to put our efforts on combating inflation, and we will provide as much liquidity as we can. It's a challenging one, absolutely. But the narrative that I hear in markets saying that central banks need to cut rates in order to support the financial system has been hurt by negative rates. So it doesn't make any sense to me.
Now, Daniel, is there anything fundamentally wrong with the banks? Are there systemic risks in European banks or perhaps in U.S. banks?
Well, the problem in banks is simply that a bank conducts the most amazing activity in the world, which is to put together the interests of depositors that are short-term and require their money every day and can withdraw their money every day with the interest of families and businesses that need loans for 10, 20, 30 years. So to start with, the balance sheet of a bank is a very, very challenging thing, and it's always very prone to suffer from volatility, certainly. But the systemic risk is never created by the banking business itself. It's created by the perverse incentives created by the central bank policy. Negative rates obliterate the profitable asset base of banks. They have loans that are provided at very low rates and therefore loss-making or generating low returns below cost of capital. And it's also central banks, the ones that incentivize taking more risk by penalizing deposits, by penalizing having cash. No? And so all those things are regulatory problems. But regulation is not the solution when regulation is the one that says that owning a massive amount of sovereign bonds is actually advisable when it's obviously something that hurt massively Silicon Valley Bank, for example.
And what do you think officials should take away from this banking turmoil?
They should take away that negative rates are the destruction of money and that negative rates have very negative consequences afterwards. Will they? I don't think so, but they should. They should take away that if the central bank purchases long-dated sovereign bonds and mortgage-backed securities, the message given to the financial system is that the lowest risk asset is long-dated sovereign bonds and mortgage-backed securities. Is that Silicon Valley Bank was not accumulating risk in something that they thought had a lot of risk, but the opposite. And that the mismatch between assets and liabilities, between duration of assets and liabilities, is very difficult, virtually impossible to hedge when the return on tangible equity is so low. That is another thing that they should take into account, because the narrative that you have heard and I have heard is that Silicon Valley Bank was stupid because they had these long duration bonds that obviously when deposits fell created a massive financial hole. Well, it was virtually impossible for them or for anybody else to hedge the interest rate risk without entering into massive losses.
And let me just get one more quick thought. You know, these interest rate hikes, it's not just the banking sector that are affected by these hikes. There's plenty of other areas. To you, do you see another domino to fall because of these hikes?
I don't think that the hikes are to blame, to be fairly honest. I think that it's the decade of negative interest rates what has created this problem. And what we're seeing now is the symptom of that problem. I think that if anything, we need to understand that central banks are incredibly dovish in reality, because interest rates continue to be negative in real terms, and they continue to provide ample liquidity. So central banks are not the ones that are certainly creating that volatility. I think that volatility comes from more than a decade of excess.
Daniel Lacalle, Chief Economist at Tristis Hedge Fund. Pleasure having you on the show today.
Same here.